So as we were discussing, today we'll try to understand the financials of a company, so of any organization. So there is something called as financial statements. Most of us might be familiar what these are, but we'll touch upon once again reiterate some of the common terms, but we'll try to stress some more time on the new elements if at all we come across. So on the left hand side, we can see a quick contents what we can expect in this session. So we will try to see what financial statements are and why they are typically used, how they'll be helpful, and we will see different types of financial statements. Some of the familiar ones: balance sheet, income statement, cash flow. We all know these things, and there are a couple of new entries here, which is called changes in equity and statement of comprehensive income. We'll see what these two elements are, and towards the end we'll also depending upon the time, we'll see if you have if we can look at the limitations of some of these popular financial statements. So to start with, financial statements. So what the financial statements are? So typically any business does its operations to make profits and all, right? And so basically the financial health of a particular business or organization, how well it is doing financially, can be represented using these financial statements. And why do these financial statements are typically needed? So for various reasons. So typically, let's say if you have a particular organization have to pay taxes, so if it's a public company, then there are rules or laws that the company has to follow, that it has to maintain a proper set of financial statements, so that whenever needed, any organization or agency can come and audit the company for necessary tax related accounts. And not only for public companies it is mandatory to maintain financial statements. These days almost all the companies, be it private companies also, they also have various set of reasons for them to maintain financial statements, because often they look for funding from various investors. So investors, the way that they are aware of to assess the financial position of a company is with the financial statements of a company. So there is an so be it whatever the company, there is a need for it to maintain a record of financial statements of these various different types of financial statements. Thereby it will help all the stockholders or stakeholders who are interested in knowing about the company. So we'll come to key takeaways a little later, but yeah, so this is something that we have understood basic that why at a core level financial statements are needed. In general, also for a public company, you can see people trade company stocks, right, on stock market and etc. So for those purposes also, it is important for them to make these statements public, so that the normal trader, retail trader, is aware of these statements, and they can try to purchase or sell stocks accordingly. And typically there is a report that we might be familiar called annual report. So all these financial statements will be disclosed in a company's annual report. So we'll see this is something completely another topic. It is related, but we'll see if in the coming sessions we can take a look at how we can read annual report and what all of those stuff. But as of now, let's focus on financial statements alone. So yeah, so this is basically, as it suggests, it tries to financial statements of these various sorts will try to evaluate a company's financial health and earning potential. So the basic stuff any sort of investor would look for, right? So those are conveyed from the financial statements of that particular company. And a quick fact here, so financial statements are normally created based on set of rules, and there are two such set of rules typically that are mostly followed. One of them is called General Accepted Accounting Principles. This is predominant for US companies, so it's called GAAP in short form, GAAP, and there is another international standard which is typically called IFRS, International Financial Reporting Standards. So typically we will see, so these are nothing but there are set of principles or rules that accountants needs to follow while creating these financial statements. So yeah, so there are two sets of rules likewise, just for our understanding. Now, so that is pretty much a brief about what financial statements are and why they are used at the core. Now let's get into each of these financial statements. First of them is most of us may be familiar. It's called balance sheet. So balance sheet at overview level, it will just try to provide an complete picture of what the company owes and how much of the company is owed to. Right. So in short, assets and liabilities. So basically, assets are the assets are entities which company is adds value to the company. Liabilities are basically where company owes, maybe such as debt or any other factors, right? Payables, etc. So there are.
Jagdish, I think I'd like to add a little bit here.
Yes.
So if we can please open a whiteboard.
Okay.
So
just a second.
Yeah. So in the meanwhile, see, accounting is called the language of business. Okay. See, business is everywhere, right? So where is business? When a milk person sends you milk early in the morning, right? There is business there, right? You get a newspaper, there is business in it. You go to a college, right? So it is not quote unquote business, it's education, but still it is, there are transactions, they still expect you to pay, and there are transactions. So business is there everywhere, right? Almost any human activity you have, there will be, wherever money is involved, or even where there is no money involved, there is money involved in one way or the other, right? So let's say you go to you ask the milk person, what's the cost, right? How much is per liter, right? So what have you asked? You have asked for cost, as in that is also accounting related. So that's the price that he's charging us, right? So that's why accounting is called the language of business, and it's there everywhere. That's the first point I would like to make. The second is, so see, if you look at it, so now I'm actually going to tell you a little bit of a brief about how accounting works, okay? Because that is necessary for you to understand what these financial statements are. I think in a moment, you'll understand, hopefully. Let me just see. Let me try and explain them, all right? So, see, the way, there's something called double entry system, okay? So the way double entry system works is that for every transaction, right, there are two aspects. One aspect is sort of an inflow and an outflow. For example, we sold 1 bottle of milk, right? So there is something that goes out, which is the product goes out and money comes in, right? There are two sides to it. This is called the double entry, right? So how do we transact? So for example, money has come in. So let us say, bank account goes up, right? Or the cash goes up and your inventory comes down. Okay. I'll give you another example. So let us say, for example, that you have purchased some product, right? You purchased, let's say, some material that is required. So the material comes in and cash goes out. Okay. There are two sides to it. Okay. So let us take maybe one other example as well. Let us say, so you're doing very well and you have lots of profits. Now what you do is you declare dividends. Okay. If you declare dividends, then money is paid out. Okay. And the capital that is in the company actually comes down. These are the two aspects to it. Okay. So this is the building blocks. It's just like a brick is a building block of a building, right? This is the building block of accounting. Okay. So, so I'm still unable to draw. So what they do is, see, they will see what is accounting. Accounting is nothing but they keep on accumulating all the transactions, and the transactions are then summarized. Okay. Each transaction that I spoke about is an entry, right? And that entry sort of creates, let's say, it is actually called an entry. It's called a journal entry in the books of account. And you have all these transactions, all the transactions are accumulated. Now, if you have a list of transactions, then you'll not be able to understand what has happened. So they summarize them into 3 statements, okay? And the following are the statements, okay? So number one is, okay, in this year, what happened finally? Can you tell me totally how much revenue did you have, how much expense you had, how much profit you had, and things like that? So that is the first one. That is called the income statement. The second is, okay, I understood what happened, through this year. Tell me at the end of the year, how does the situation stand at this point in time? For example, there are very critical aspects, like, for example, how much inventory do you have? Because there are many businesses that don't sell through the inventory and the inventory piles up, right? So how much inventory do you have? Another thing that happens is they're selling. The money the product has gone to the customer, or services have been provided to the customer, but the customer has not paid. If the customer has not paid, then there is no money in the company, right? There are many companies that you would know of that sort of, you will see problems like, see, these people haven't been able to pay the vendors, right? Why? They may have sold something to the customer, but the money has not come in. Okay, so this you are going to hear in some time, because of the financial crisis that is, I think, in the offing. That's a possibility, right? So, so that's the cash side of it, right? So you take a screenshot, so to say, a picture of how the company stands as of the end of a particular year, not through the period, but at the end of the period. It's like going to a river, right? And you take a picture of what's going on, right? So that picture is as at that point in time. But if you count what is going on through the year, right, and accumulate all the water that has gone in, that is more like the income statement. Okay, these are the 2 aspects, and there is a third aspect as well, which is called the cash flow statement. Okay, the cash flow statement means, so for example, see, as of now we are surviving. See, we looked at the WeWork, right? There is a company called WeWork, right, which is quote unquote a unicorn, right? And but if you look at it, they do not have much profit, right? And sales are some, but they have so much interest payment that their entire revenue equals their interest payment. Okay, it's a zombie company, right? So for that kind of a company, for example, you would like to see, why are these guys surviving? Then you will ask for what is called a cash flow statement, because then you will know where is the money coming from and where did it go. Did the investors give the money, or is it like they spent too much money into, let's say, land and machinery and buildings and so on and so forth, right? Or what else happened? Maybe there is something else that has happened, right? So these are the things. So there are 3 statements. These are the principal statements: balance sheet, cash income statement, and cash flow statement. Many times in the usual parlance, right, they will say, give me your balance sheet. Balance sheet is the only term that they understand, right? But what they're actually referring to sometimes is they're referring to income statement, right? But they ask for balance sheet. So there are 3 things: income statement, balance sheet, and cash flow statement. Okay. All right, Jagdish, over to you now.
Oh, yes, it's me. Thanks, Chaitanya. So that was a very good way to explain all these statements in a detailed manner, easy manner. So yeah, so topping on the same thing, I'll quickly move through these three statements that Chaitanya has covered, just reflecting upon some of the points, right? So on the balance sheet, basically we have assets and also liabilities, and also there's something called shareholders equity. Under the assets, we can see the terms which Chaitanya was talking about. So the cash, so total how much cash do we have, maybe in the bank or something like that. And accounts receivable is the amount, let's say the example that Chaitanya was talking, right? So you have sold the product but you didn't receive any money for it, so all of that will be accumulated under, I guess, accounts receivable. So that's also considered as your asset, but it's still not considered as cash in hand. And likewise, inventory is another element which is considered as, if you have a product in your warehouse or something, that is also considered as equivalent to asset, which you can liquidate by selling it, etc. And likewise, prepaid expense, there are multiple entries like that. Only one thing to keep in mind here is there is a term called current assets and long-term assets. So current assets is basically the general convention is that current assets are something that which you can use up in about a year's time or something like that, whereas long-term asset is considered something that which is long-term, that you cannot completely use it in a year. Like, let's say for example, you have purchased certain equipment or certain plots or sites, etc., for expansion, buildings, all of it. So all of those things will come under the long-term current assets, long-term assets actually. And likewise, there are a few other elements here, and there is one thing that you can need to notice: the intangible assets can also be considered as assets, normally trademarks, patents, and etc., etc. And likewise, we have liabilities. Now these are something that company is supposed to pay to others, so the company, the money that is supposed to go out of the company. So this is something called as accounts payable. Maybe this could refer to money that company has to pay for suppliers to procure raw materials and all, right? So how much money I owe to the suppliers, so that can come under accounts payable. And likewise, wages, etc. And if it's a public company, maybe the dividends that needs to be paid to the shareholders, etc. And long-term debt is considered as long-term liability. So there is again same concept, so current liabilities and also the long-term liabilities. And that there is these two are the main components, and there's one third component within the balance sheet, which is called equity. So the way the equity is calculated is simply you take the assets, total assets that you have, subtract the total liabilities from it, and whatever remaining is your considered as the total equity of that particular company. So now, depending upon, there is one term called retained earnings. So typically what this conveys is, let's say your equity has turned out to be some amount of money, positive money, right? And it is completely up to that particular company's discretion, that if they want to typically what people do is, once they have a certain amount of money in hand, they will give out the dividends to the shareholders, and whatever the rest of it, they will continue to keep it as retained earnings, which will become a component of assets in the next year. So they will take out a certain chunk of money that they have made, share some portion to the shareholders as dividends, and maybe some of it they will retain it to the next year. It completely depends how much they retain, how much they share it with shareholders. Completely depends upon that particular company and the situation which they are in. If they are typically trying to expand more, reinvest into the business, grow faster, then in that case they may opt to completely halt the dividends that they send out to the shareholders. In that case, the majority of the chunk will be retained as retained earnings to the next year's balance sheet. So there is a sample balance sheet that which we can see here. So currently there's a company that you might be familiar called ExxonMobil. We have been so this is how a sample balance sheet will look like. So on the top we can quickly see there is a quick we'll go into the screenshot in a minute, but yeah, so there is a total assets worth 338 billion. Total liabilities are worth 163 billion. And when you subtract as liabilities from assets, you will see the equity to be 175 billion. So this is quickly a quick snapshot of the balance sheet. So what we see here is, let me see if okay, yeah. So for each year over year, we can see at the end of December, as Chaitanya was talking, balance sheet is as a snapshot at a particular point in time. So we are looking at here end of December 2020 and end of December 2021, as in that particular moment, how much assets do we have, how much liabilities do I have, and what are the different components of liabilities, etc. And what is the equity that I have, and at the end we'll see the net basically. So this is a
Jagdish, so what I think it's a very good idea for all our folks to look at this balance sheet, right? We are currently looking we are looking both at equity and liability, assets and liabilities, and we have equity at the bottom. Just scroll down a little bit. Do we see anything more?
That's it. Yeah.
That's the end of it. Okay, excellent, perfect. See, we are able to fit the whole balance sheet here. Can we look at this balance sheet and then try to understand what this is? What is going on, right? This is as of end of 2021 and 2020, right? So what is going on? Can we try to understand this?
Sure. So if I have to start,
Jagdish, go ahead for sure. But this question is for everyone, okay? Just so you know. But you go ahead, Jagdish.
Yes. Yeah. So leaving out the basic structure that we already discussed, so if we get into some of the elements here, we can see this particular company has, at the end of, let's take 2021, has cash in hand of 6,000, it's basically $6 billion, and accounts receivable, it's way higher. So let's say assuming $32 billion accounts receivable. That means there's a lot of money that these people have to receive. So from other parties, maybe it's customers or something. And then we have entry for inventories. How much inventory do we have? And typically, if we know more about the business, maybe we will try to understand, okay, I don't know, maybe if there are, given the situation, if there is a shortage of any of these raw materials, how long can we survive on these inventories? So all of those can be reduced maybe from these inventory related stats. And so here we are seeing other current assets, basically something that cannot be categorized. In total current assets, we have roughly, we can see $60 billion, but we know that majority of this chunk of that, only 10% is available to us as cash in hand, and almost 50% of it's something that which we are yet to receive. So and likewise we can see following long-term assets after the current assets, and similarly I think we can reduce liabilities and equities.
Okay.
So compared to the last year and this year, we see that the cash and cash equivalents and the notes and accounts receivable ratio, if you see, it's 4:20. Here it's 6:30. It's almost the same. It hasn't changed, but it's not the case for liabilities. So if you see,
which one, Sina? Just clarify what exactly you meant.
Cash and cash equivalents versus notes and accounts receivable. So
this ratio that you're looking at. Okay, got it.
So in this year, the business hasn't changed. So the customers who have paid on the credit basis have been doing the same, and those who paid on cash are still doing the same. Nothing has changed. It's 4:20, and here it's 6:30. But on liability side, it has changed. See, notes and loans payable, it is 2458 is to 35, and if you see this year it is 4 and 50. So the company has given out more cash, and the payables that they have to pay has slightly increased. So cash has come down here. So nothing has changed on the income part, but on the liabilities part it is affected. So as a net in this year, a lot of cash has gone out of the company as well.
a good point. See, I would also look at, just to add to that, see, we don't know how much revenue they have, okay? But if you look at this, so I think, so I think like both Jagdish and Tina were talking about. So you have this $20 billion, which are account receivable as of the end of the previous year. But this year, their account receivable has gone up, right? Almost by 50%, right? More than 60% it has gone up by,
Right.
okay? So which means that it is supplying to the customers, but the customers have not yet paid, okay? What this means is it translates to cash outflow from the company standpoint, okay? So then you can ask, see, how did the company fund this? See, the company can fund it in a number of ways, right? The company can, let's say, get new investment and they could have funded. Let us see if that is the case. See, if you look at this, right, common stock, you can see it right here at the bottom, right? So you see common stock has not changed. Let us see if there is anything else that has changed in the common stock, right? See, there is common stock held in treasury, right? The total equity, look at the total equity. Total equity has gone up by a little bit, right? So from 164 billion, it went up to 175 billion. Can everyone see it?
Yes.
Right? So what has changed here? Is it like they have profits? Okay, you can see there is earnings reinvested, which is almost to the same degree, right? So it's roughly about, actually about what, $9 billion, correct? But the equity has gone up by about $11 billion. You can see this one. Look at the difference between these two and those two, right? So which means most of that money probably has come from profit. That is what we are seeing. We'll have other things also that we should be looking at here. So at least some part of it is explained here, but let's look at this. I would like you to look at this particular one. See, what is that line showing? 35 and 50, right? So it was 35 billion as of 2020, and 2021 it has gone up to 50 billion. So an increase of $50 billion. What this tells us is that much of this accounts receivable, right, is funded through the external parties of the company, which are suppliers.
Right.
Right. So see, from looking at it from a very, I would say, selfish perspective of the company, if vendors are funding it, we have no problem, isn't it? Right? If we are paying interest on it, then that is negative on the company. But if our vendors are funding it, it is not necessarily a great thing. It's not necessarily a good human being thing, right? But your debtors are being funded by your creditors, okay? As in your customers are being funded by your suppliers. You're not necessarily funding it. So that is what this is showing.
Yep. Right.
Understood? Anything else you guys have noticed? Would you like to, anyone would like to discuss any other observations?
Just by the way, like we do have, like, for the same company in the same durations, cash flow and income statements as well.
Yeah.
Got it. Yes. Yeah. We will get to that, Jagdish.
Yeah.
Guys,
Can
any
we
other
draw
observations?
any sign, Chaitanya, any positive or negative sign? Because the debt is coming down, but at the same time, the accounts payable is also increasing. Like, any negative sign or positive sign for the company is this?
So can you just explain that question, Surya?
Actually, just wanted to understand if can we draw any positive angle or negative angle from this balance sheet?
Inferences, right? Yeah. So yeah, that's actually what we are trying to do. So I think you had a point about debt, right? Is that correct? So the debt seems to have come down, which is a positive sign generally, right? If you look at this, right? So 47 billion was last year, but this year it is $43 billion. So debt has come down. Typically, if debt comes down, right, then it means that the company has to pay lesser interest. right? So that is what it means. Okay, so certain other points I would like you guys to observe, right? So look at this, see the total assets, right? Let me just look at this one more time. So you have the total assets, right? If you look at this, so there is one item that is very large in all of the assets. Which item is it and what proportion is it?
PP is
Yeah.
higher.
Yes, property, plant and equipment, that is very high. And what percentage is it?
Close to 60-70%. 60%.
Huh? So it is almost, yeah, it is more than
70.
roughly about 2/3,
Yeah.
right? So what is the nature of this company? This is ExxonMobil. ExxonMobil is an oil company, right? If you have an oil company, what does an oil company need to be able to produce that oil? They need refineries, right? So refinery or whatever is the processing, I think there could be some petroleum engineers amongst us. They are going to kill me saying, no, it's this kind of company and so on. But they need large, sort of machinery, property, whatever, plant, equipment, etc. that is required in order for them to be able to produce it. So that is why what this tells us is that this company is a capital intensive business. Right? You need large infrastructure to be able to do this, right? So that is one thing. Let us see if there is anything else you guys want to, any inferences, any observations you guys have?
So their liabilities are not more than 50%. It's mostly equity, funded by equity, and like the assets are 338 and liability is 163. So the remaining is equity.
Correct. Yes. So I think so. So just look at this, everyone. Look at this number at the bottom, right? And look at this number at the or almost at the end of assets. What's the difference between the two? This is not a trick question. It's just a numerically, what's the difference between the two?
It's always zero.
Zero, yes. So always, so I told you about the double entry system, right? One of the consequences of double entry system is that a balance sheet is produced where assets and liabilities are always equal. Okay? If there is any difference between the two, it is considered like, there is something really wrong. Even if there is like a dollar or a rupee difference, it can translate to a very big item missing, or it can be very trivial also. We cannot say, right? That needs to be diagnosed. But assets and liabilities are always equal. Look at what Sinha mentioned. See, at the bottom we have, we have the assets. So total liabilities, $338 billion, of which this one, which is the external liability, is only $163 billion, right? Which is roughly 50%. Which means, if you think of it, more or less, the shareholders own 100% of the voting rights, but they own roughly 50% of the company. The external liabilities are about 50%. Okay, what does this say? Let us say if instead of this 163, let us assume for the time being that this is 300. What does that show?
It's a leveraged company.
It's a leverage. What does it mean? Is there a lever that you can pull? What does it mean?
It's mostly run on external loans and like debt funding, not equity funding.
Correct. Yeah. Even though we don't want to discuss about the company again and again, I told you about a zombie company, right? So, that company, if it has lots of debt, it will read maybe 300, 325. If something like that is there, then it tells us that the company doesn't own anything. It essentially has borrowed a lot of money and put it in some kind of an asset, property or whatever, right? So it tells us. So on the other hand, let's look at it like this. right? So let's look at it like, okay, this is not 163, this is just 16, 16, okay? And the rest of it is all here, right? And sort of total equity, basically. So what I meant by that is, instead of that 175, at the bottom, you have the rest of it. About 320 or something. Then what does that show?
Complete contrary. So the company owns a lot of assets.
Owns a lot of assets, and not just assets, but also the amount that has to be paid to an outside party is very limited. The company actually has, quote unquote, equity. It owns it. Right? The shareholders own it, which actually reflects on the strength of the company. Why it reflects on the strength of the company? Because see, if you have been able to pay out all of the external debt, right, without any external debt, and if you have lots of whatever, then it owns it. Then it means that it is more, quote unquote, wealthy, as opposed to the other way around, where it has to pay out a lot and only a small amount remains with the organization. Okay. Yeah.
Generally,
all right.
When they talk about ROE, so they'll give a percentage, return on equity percentage.
Return on equity.
Equity.
Yes. Return on equity. So correct. Go ahead.
Yeah. So then we'll have to first know how much equity the company has, because without that percentage doesn't make sense. That the denominator is equity, and if that equity is low, then the company is more debt funded, and debt is like a double-edged sword. So it can either bring down or take it really high if there are profits. So you need to understand the equity values, how much is it.
Right. So there is a metric called return on equity. Return is nothing but the profit that the company has earned. So return divided by equity, the 175 number that you're looking at, that is a metric. So that metric people use to understand, see, how much are these guys earning, right? So frankly, it depends from company to company. So there are companies, take Exxon Mobil, right? Essentially large amounts of capital is invested, right? In order to understand, does this company work well or not, an easy metric is to understand, hey, how much, just like you go to a let's say a bank, and you put in your fixed deposits, right? And these days, how much is the fixed deposit rate of interest? Does anyone know?
Around 6.
A little around 6.
5.3 in SBI.
Less than 6, yeah.
Sorry?
Little less than 6.
Yeah.
Little less than 6? Okay, Surya, you were saying something.
In SBI, it is 5.3%.
5.3%. He knows exactly how much it is. Surya, all right. So, see, if SBI is giving you 5.3%, right? And there is this other company who, says, I'm going to build, such a large factory, large this, that, and all of that. And net, they'll give you 2% return on equity. Does it make sense? Right? No. So, and there is a lot of risk also, right? So you would rather give to SBI, right, which Surya is doing, right, rather than give someone else, and put through a lot of risk. So, but on the other hand, if the person says, no, we are able to give 10% return on equity, then that's a different matter. So that's why these numbers matter. All right. Okay. All right. So I think we can actually discuss a lot more on this.
Actually, we can continue on this in the next session.